Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, U.S. Defense Secretary Pete Hegseth gives an update on Iran as we near the end of week 2 of the war.
We know the new so-called not-so-supreme leader is wounded and likely disfigured.
Plus, Adobe CEO Shantanu Narayen will resign amid skepticism about the company's ability to thrive in the AI era. And the S&P is considering changes to rules governing how companies join its index, which could fast-track SpaceX's entry after an IPO. Let's get to markets, and this is what the financial markets look like this Friday. It's a kind of continuation of the broader theme of the week. There is slight pressure on equities. The Nasdaq 100 is modestly lower, basically flat. And you see Brent crude, the global benchmark for oil, above $100 a barrel, with a micro focus of what's happening in the Middle East and the Gulf. There has been some other news flow and earnings considerations around that when it comes to the tech sector. We can get to those later in the hour. But right now it is very much the macro and what is happening with the war in Iran. President Trump and Iran's leadership are both striking a defiant tone as the war in Iran is in its second week, with Trump vowing new strikes with, quote, unparalleled firepower. U.S. Defense Secretary Pete Hegseth has also weighed in, saying Iran's new supreme leader is likely wounded following recent attacks. Here, with all of the latest, is Bloomberg's Washington correspondent, Tyler Kendall. What do we need to know?
Yeah, hey, Ed, good morning. Well, as you mentioned, the U.S. is threatening Iran with fresh attacks, the latest suggestion that there is going to be no let-up in this conflict. We heard from President Trump in a post on Truth Social earlier, where he said that the U.S. maintains unlimited ammunition and has, quote, plenty of time. Plus, we heard from the U.S. Defense Secretary Pete Hegseth in a briefing to reporters earlier today, where he confirmed the U.S. and Israel have hit more than 15,000 Iranian targets and says that Iran's one-way drone usage is now down 95%.
That the United States is decimating the radical Iranian regime's military in a way the world has never seen before. Never before has a modern, capable military, which Iran used to have, been so quickly destroyed and made combat ineffective, devastated.
From an operational level, we know that ensuring safe passage through the Strait of Hormuz remains a top priority, as Secretary Hegseth went on to say, quote, we've been dealing with it. Bloomberg News is now reporting that several back channels have been opened between U.S. allies and Iran about reopening the strait, though sources caution that they are not optimistic that the efforts are going to yield results. Earlier today, a Turkish government official did confirm that a Turkish-flagged vessel did make its way through the critical waterway, the latest example about negotiating for safe passage. But, Ed, as there is mounting political pressure on President Trump when it comes to higher energy prices, we did see the U.S. move to waive certain sanctions related to Russian oil. We saw a second temporary waiver issued for those cargoes that are already at sea. Ed, at this point, our data analyzed by Bloomberg estimates that this could impact nearly 310,000 refined products.
Bloomberg's Tyler Kendall, thank you. With the war in Iran continuing to roil the region, Meta has announced it's pausing part of its major internet expansion efforts in Africa, specifically work on a key underwater cable system that would have run through parts of the Middle East, including Oman, the UAE, and Saudi Arabia. Here with the details is Bloomberg's tech editor, Olivia Solon. We're showing the kind of map, the network, Olivia, of the cables zoomed in on the Gulf region. Explain the actions that Meta's taking and the details that we need to know.
Right. Well, because of the war in Iran and the missiles that have been coming across the Persian Gulf, Meta, has been kind of forced to take the decision to stop building part of this enormous cable system it's been building for a while called To Africa. They've actually built the bigger part of it around the continent of Africa. But last year, they were forced to sort of delay work on a section running through the Red Sea because there were Houthi missile attacks on ships there. And when they did that, they said, it's OK, we've still got this other section going through the Persian Gulf. And that's the part that we're talking about now. Well, now, because of the missile attacks there, the boats that install cables have issued what's called a force majeure notice, saying they can no longer continue to meet their contractual obligations due to obviously the massive safety concerns. And so that means this part of this very important new high capacity fiber optic cable is on hold.
The bigger picture for Meta, what is it that they were trying to achieve in Africa, in the region more broadly, in laying down basically what is updated infrastructure?
Right, they want to bring a huge amount more connectivity to the Middle East and Africa, and I think they will. They've already succeeded that partially, but this huge section, both in the Red Sea and now in the Persian Gulf, means that this additional capacity that was going to really help sort of fuel the data center build out that's happening in the region is not going to be available, at least in the short term.
Bloomberg's Olivia Solon, thank you. Another Meta headline. The company is reportedly delaying the rollout of its latest AI model after internal testing showed it underperformed compared with rival systems. That's according to a report by the New York Times. This is how equity markets reacting to that. Meta under pressure, down almost 3%. Then, looking at the trading, particularly in the pre-market, Alphabet, parent of Google, is up half a percentage point now, but had been up a little bit more markedly. For more on what this kind of indicates about the competitive landscape and what it means for investors, Aoka Yoshioka, Portfolio Consulting Director at Wealth Enhancement Group. And, interesting case study, right? Meta and Alphabet, both names that you hold, that you look at. There are, let's say, 3 or 4 berths for big frontier model labs or the big tech companies working on next generation models. And when you get a piece of news like this, you see Meta move to the downside, Alphabet move to the upside. What do you interpret from that?
Sure, Ed. So, when we think about both of these stocks, we try to look at things in the context of the long term versus some of these short term moves that we're seeing in markets. We do see these dislocations from time to time, but over the long term, we know that the growth rates for both of the stocks are very high, and they've got high quality balance sheets supporting the growth that they're trying to accomplish.
Right now, we're trying to digest still ongoing data, largely relating to earnings. And I think just before the earnings season hit, you had many people in the markets come out and say, this is what we will judge momentum by, simply earnings performance. In aggregate at this point, when it comes to particularly the hyperscalers, but our focus on AI, what was it that you learned from the earnings season?
Earnings season provided a lot of incremental information just regarding the overall build out of AI and where we are, and the focus that investors have on that return on investment that everybody wants to see, just given how much CapEx is being spent by the overall hyperscalers. But, we also saw that earnings wasn't everything, especially in the software space, in which earnings continue to go higher, and yet the multiples got destroyed.
So the software space, interesting. I guess if you look below the index level and take a look at January, February, now March, what was it you saw in investor behavior and the attitude towards the tech sector?
Sure. So, it really depends on some of the macroeconomic data that we've been dealing with, some of the geopolitical data, too. January and February, we clearly saw that sell-off in software, and it reversed in March as a little bit of a flight to quality. Again, seeing a little bit of a bounce from something that had sold off quite a bit and less cyclical per se. And you saw the safety of the Mag 7 as well during this sort of geopolitical conflict that has been going on.
What's dominating the news cycle is war in Iran. Again, from the technology investors' perspective, what is the incremental data, the soft data, the macro level data that you're tracking to make decisions with the portfolio?
I think from our standpoint, it's clearly the duration of this conflict, which is going to be key. I think everybody else has talked about this, and it's the one thing that nobody really can forecast. If it's short, it's great. If it's a little bit longer, it's a little bit more detrimental. There's key raw materials, especially for semiconductors, that could sort of offset some of the production issues that we've seen in the past. And so, really supply chain issues, we don't want them to kind of come back again and, really hit inflation inflation. And so those are some of the key metrics we're looking at. But tech specifically, I think, can be a little bit more isolated just because of the long-term secular growth nature of a lot of the companies in the tech sector.
AI is still the dominant theme for you?
Absolutely, especially when it comes to technology and for the overall market. It's just the overall contribution from the hyperscalers and CapEx and what that means for the overall U.S. economy and globally as well. And just the use cases and the workflow changes for a lot of enterprises, I think, is the predominant sort of issues that we're all trying to figure out over the next several years.
Okay, so next week we either do or we don't have a big macro event, which is NVIDIA's GTC conference. It's so difficult to gauge how that moves the needle. Are you genuinely sort of braced for it as a big item on the calendar? Or kind of noise, really, and hype around what's happening?
It's really going to depend on what kind of information sort of comes out there. NVIDIA stock has been a little bit range bound for the last several months, and hopefully, if they have some sort of big announcement, perhaps it moves the stock. But I think the bar is high. You've seen earnings growth of over 70%, and the stock is trading at 22 times. We're going to see some updates on Vera and Vera Rubin and even Feynman. And I think when we get some of that additional detail, perhaps it will move the stock.
Right. At NVIDIA GTC in DC, we got that surprise $500 billion figure from Jensen Huang, which was literally on a slide behind him, and a little more information than that. Ayoko Yoshioka of Wealth Enhancement Group, great to have you back on the program. Thank you very much. Some news, Amazon plans to use chips from startup Cerebras alongside its own Trainium processors. It's a combination that the companies say will be able to better run AI software. AWS will begin offering a new service based on the arrangement in the second half of 2026, according to a statement. Financial terms weren't disclosed. And when that headline hit, by the way, there was a little move lower in NVIDIA to session lows, but it kind of bounced back after. Okay, coming up, leadership uncertainty at Adobe overshadows otherwise pretty steady results. We're going to discuss that next. This is Bloomberg Tech. Shares of Adobe are really under pressure here. We're off session lows, down 6.5%. At one point in the session, we're on track for our biggest drop in exactly 1 year to the day. On the week, Adobe very close to having its worst 5-day performance since the end of 2024. The news, the company announced on its earnings call that Shantanu Narayen, who served as CEO for nearly 2 decades, is stepping down. The stock has already been under pressure anyway, down over 30% on the last year or so, as it faces concerns about its ability to thrive in the AI era. Let's get to it. Bloomberg's Brody Ford is here with us. I mean, this is not a new story with Adobe and whether it is managing well transition into the AI era. But we'll start with Shantanu. You and I exchanged emails about, well, what happens next? So tell us, there's an effort to find a successor. And I guess, did we get any insight as to why Shantanu's decided to take this decision at all?
Well, Shantanu was a legend, right? I mean, he was in that seat for 18 years, and he gets a lot of credit for turning Adobe from a company where you just buy Photoshop or another product one time to one of these recurring subscription businesses that is just the norm now, but at the time was quite novel. But at the end of the day, I think he was seen as a CEO of that era. And the AI era, a lot of these SaaS companies are needing to undergo a transition, a reinvention. And it appears that he or the board or somebody decided that he might not have been the right person to lead that transition.
There were some data points in the earnings themselves, customer behaviors, for example, particularly about images, things like that. What did you learn about the AI story for Adobe?
People are using AI within Adobe products, but the big risk for them is that the cost of content creation has gone down a lot. A lot of the hit creative programs are not made by Adobe, right? I mean, Adobe's valuation for a long time was based on being really kind of the only game in town if you were a professional. And every day that becomes a little less true, and that's what they have to reckon with.
We said at the start of the segment, so we should probably go back to it, that actually earnings were okay. You know, if you can move past the news that the CEO of the last 2 decades is moving on, what did the numbers say about the business?
It's quite similar to a lot of the big SaaS names, whether it be Workday or Salesforce, that they're seeing steady growth, slight deceleration, some uptick of their AI products. But at the end of the day, it's just not enough to convince investors that AI will be an additive and not a competitive force against their business.
Bloomberg's Brody Ford, all across the software space. Thank you very much. Another news item, a jury in Los Angeles will soon decide the outcome of the high-stakes social media trial and the claims that sites like Instagram and YouTube are dangerously addictive to young people. Final arguments just concluded after roughly 4 weeks of testimony from medical experts, a whistleblower, and Mark Zuckerberg himself. The jury of 7 women and 5 men is set to begin deliberations today. Now, coming up, Ramp CEO Eric Glyman joins us to discuss the company's latest acquisition and an expansion into Europe. That conversation is coming up next. This is Bloomberg Tech. Fintech startup Ramp is acquiring European payments platform Billhop. The deal will help Ramp expand its footprint, in large part because Billhop is licensed in the UK and Sweden. Let's speak with Ramp CEO Eric Glyman. And like, this is interesting, right? I think the best place to start is Europe. If you regard UK as Europe and Sweden and the Nordics. You know, why Europe and why now with this, Eric?
Ed, thanks so much for having me on. And it's a region that we're incredibly excited about. We're already working with so many of the fastest growing companies based in Europe. We think about companies like 11 Labs to great companies started by European founders like Stripe and Vercel. And I would say Europe is having a moment, and we want to be there for it and bring so much of what we brought to American companies to the companies operating in that region.
That's an interesting point. Like when you posted the news this morning on different social platforms, you know, one of the interesting points of discussion is what is the competitive landscape like for you in Europe and how is it different to in the US? So like in America, and correct me if I'm wrong, but you go up against kind of the big banks. Is that the same in Europe or is it a different industry there?
In many ways, it's very consistent. I would say whether it's the US or even in Europe, classically, if you were a bank, you were able to move money. And if you weren't, you could sell weird aftermarket software to do your expenses or pay your bills or things like that. And the result was probably what most people still feel of, 1 hour a month, you have the worst hour, slowly doing your expenses across different systems. And part of what we proved out in the US is it doesn't have to be so hard. We've created cards where you tap them and your expense report is done for you, your books are closed for you, and the result is that companies spend less. The average business spends about 5% less, and the average business on Ramp grew last year by about 16%, which is multiple times the U.S. average. And so just as we've brought this to the U.S., we want to bring that same innovation and more to the great companies being built and operated out of Europe.
Operate out of Europe, but like lots, it's a global world. It's a funny thing to say, but many of your customers or clients, right? They would have a footprint operationally in different jurisdictions, like the US and Europe. And is this kind of therefore about like the multinational client that you're trying to go after?
It's a bit of both. I mean, so for today, let's say you're a multinational leader like a Shopify or like a CBRE. You can issue cards today locally and make payments all around the world, in Europe, in Asia, in Latin America. You name it, Ramp is able to do that. But part of what this acquisition brings is the capabilities to serve European headquartered or based companies without operations in the United States. And so they're able to benefit from that same global infrastructure, but it really allows us to reach a much larger market.
Talk a little bit about Ramp, the company, the startup, and you running it. You have like the who's who list of investors. And what I find interesting is not common, not unique to you. It's come up a lot recently. You sat on a lot of the money that you raised for quite a long time. You've gone out and done an acquisition. What's that like, deciding to spend the funds raised?
It's, look, with everything we do, just as we're trying to help our customers get more from every dollar an hour, we want to too. And I think you're exactly right. The business has raised more than $2 billion of equity capital. The vast majority of it is still on balance sheet, and Ramp is even generating cash, even as we're one of the fastest growing companies in the world now.
Interesting. Would you give me a number on that? Any sort of financial metric on the health of how it's going?
I would say this. We've had 4 straight quarters of accelerating growth. The business is, call it doubling every year, which is really an outlier. And last year, I believe together, we shared that last summer we passed more than $1 billion a year in revenue in US dollars. And so we've seen that growth rate even accelerate. So it's quite unique.
You run a tight ship, and you're trying to grow Ramp, and I really appreciate sharing the data on that point. The landscape's very interesting. Like Brex selling to Capital One as an example. Like over many years on this show, the guys at Brex would never have said that would be the case. How do you feel about Ramp's independence, long term, and where it fits in a big sea of large financial players?
I think it's a really special thing. If you talk to, let's say, a finance leader of a company, let's say with 500 employees, their finance suite looks like a mess. We find there's something like 20 tools on average, something for cards, something for bill payments, something for AR, something for expenses, something for procurement, something for approvals. It's horrific. Right. And part of what we've done is collapse that and really simplify it. And I think that has first made us unique in the market and allowed us to grow even faster than the largest financial institutions. And so we're excited. We're over 2% of all the corporate and small business card transactions in the U.S. And while we're very excited about that, we look forward to taking on the next 98% and delivering something better.
Eric, we just have 30 seconds, but looking at Block as an example, will you reduce headcount because of AI?
Look, we have salespeople who are closing 2-3 times the dollar value of deals than we did last year. And from my vantage point, when you have people who can do that, you want to hire as many as you can as fast as possible.
Eric Lyman, CEO of Ramp. It's really great to have you back on Bloomberg Tech. Thank you very much. Now, coming up on the show, changes to rules governing the S&P 500 could rocket SpaceX onto the index. We're going to have details on that Bloomberg story next. It is halftime. These are the markets, and this is Bloomberg Tech. Welcome back to Bloomberg Tech. I'm Ed Ludlow. S&P Dow Jones Indices is considering changes to how companies join the S&P 500. That's all according to sources. The move could potentially fast-track Elon Musk's SpaceX onto the lists after it's expected to be a blockbuster public market debut later this year. Bloomberg's Kyle Porter is here with the details. It's a big story that the team broke and tried to explain in detail the considerations that are happening, and they are considerations. So let's start with that. What have we learned in our reporting?
Well, yeah, it's important to note that no final decisions have been taken on this. However, should S&P decide to change its rules, its committee, it would be absolutely momentous. It would, excuse the pun, put rocket fuel on the trading of SpaceX as a new company.
You and I did a story together yesterday. It was complicated, in part based on regulatory filing, in part the people we spoke to. But in short, SpaceX's acquisition of xAI has closed, and there is some ownership mechanics that took place. Explain it to our audience.
Well, I wish we had half an hour, but in short, it's effectively tidying up the balance sheet, putting different pieces of equity into different boxes. Tesla's investment in xAI has been rolled over into SpaceX. Some of the early investors who've been with Elon for a long time across different companies, those like Valor and DFJ, have also had their stakes in SpaceX slightly increased as part of these changes. It's all designed to make your equity term sheet look a little bit more normal as you approach the IPO process, which we still expect to happen this summer or into the autumn.
Okay, Bloomberg's Carl Porter, part of the team that's done a lot of reporting on, I guess, mechanics of what's happening with SpaceX ahead of an anticipated public market debut. Let's get an investor's perspective on all of it. Peter Singlehurst leads the private companies team at Bailey Gifford, an investor in SpaceX, but other names that I guess we've talked in the context of being potential blockbuster IPOs down the line. Anthropic is another example. Peter, welcome back to the show. I think it's the first time we've had the opportunity to speak since SpaceX acquired xAI. And I guess just what's your reaction to that? How you guys felt about it, the interpretation of the rationale behind it?
I think when you step back and you consider what has made SpaceX such an incredible business over the last 10 years, it's their ability to drive down the cost of launch. It's the deflationary nature of their business. And when you look at other hardware categories where we've seen that historically, such as Moore's law in transistors or Flatley's law in genomics, when you drive down cost by orders of magnitude, it opens up phenomenal, unforeseeable use cases. And we're seeing that in the domain of space. Now, Starlink has been the first application of that. And we think there's a stateable case that data centers in space could well be the next application that opens up as you drive down that cost of launch. Now, it's early days for that. It remains unproven. But if that is to be something that is feasible, being vertically integrated into an LM model, such as the Grok model, will be an advantage for SpaceX.
At the time that the news came that SpaceX would acquire xAI, we did some reporting that essentially xAI operates as a subsidiary of SpaceX. In part, there's also ITAR considerations. But there's also xAI's financial situation, which is the debt burden and its rate of cash burn. How did you feel about SpaceX taking on that balance sheet, essentially?
I think if any business is going to take on a company that has those necessary CapEx requirements, it needs to be a company that's in a very robust financial position. And SpaceX is in a privileged position of having not only a very strong balance sheet, but having strong profitability and cash flow dynamics. And so the combination of a business that does require significant CapEx in the form of xAI, alongside a business that has a history of high CapEx investment, but has been able to show how that can translate into help very strong levels of profitability, I think could be a strong combination.
Kyle did, I think, a pretty good job a few moments ago explaining the sort of technicalities of a transaction close like this. But like the big picture is the net result of Tesla now having literally a financial stake in SpaceX because of the investment it made of the Series E of xAI, that being rolled over in SpaceX. The Elon Inc. Story is kind of coming together. How do you feel about that? The proximity of those two giants?
I think there's always been a complicated web of interconnections between Elon Musk's companies. And we saw this as Tesla owners when they acquired SolarCity. Ultimately, what will drive shareholder returns will be the strong execution and growth of these businesses. And at the time of the SolarCity acquisition by Tesla, it was controversial. But in the end, it turned out not to really matter because Tesla was such a phenomenally successful business. And we believe that that dynamic will exist here with SpaceX. It is probably one of the businesses in our portfolios with one of the most robust competitive advantages and growth opportunities. If you look at orbital launches done annually, SpaceX is leap and bounds ahead of anybody else. It has an incredibly strong market position, very strong proposition to its customers, and we think ultimately that will be the main driver of returns for shareholders.
We're showing kind of the rest of your portfolio of private company investments, and I get that's actually split across more than one trust, right? But what those companies all have in common is the staying private longer. Many of them have done tenders or secondaries. Explain, what's happening in that private markets, in that private market that's supporting that theme?
Yeah, so there are really sort of two kinds of transactions that we see happening in the later stages of the private markets. We are continuing to see very large primary capital rounds where companies are raising capital to invest in their businesses. And there it's businesses such as Anthropic, such as Anduril, such as Wave, that are raising billions of dollars to invest in the huge market opportunities that they have. But that capital that they're raising is going into their businesses for investment. You then have a second category of large late-stage transaction, which are secondary transactions, where either early shareholders or employees are selling to other shareholders. And I would categorize the transactions done by the likes of Databricks or Stripe, or indeed some of the transactions that SpaceX have done in this camp. Now, what's making that possible is the fact that you have businesses in very strong financial positions that are, in many cases, generating cash flow, where they actually don't need more external capital, but where there's clear demand for their shares. And so matching off some of that demand and supply is good for employees who want to be able to realize some of the gains from their options. It's good for the companies as they start to potentially reduce some of the overhang that might exist as they come to the public markets. Right. And it's good for investors who want to buy shares in those companies.
Peter, we've been very focused on Anthropic and Anthropic's relationship with the US government, with the Department of Defense. My understanding is that there's like this group of investors that basically applaud Dario Amodei for taking, having red lines, but also, you know, there's this belief that there is a commercial advantage in holding that moral high ground. They would cite the data of Claude's placement on the different app stores and downloads activity after the Pentagon labeled it a potential supply chain risk. But it's that sort of commercial opportunity of taking the moral high ground that I wanted to ask you about and your thesis towards Anthropic in that respect.
I personally wouldn't contextualize it within the realms of moral high ground. I think this actually comes down to business culture. So one of the things that we really focus on when we diligence business is the cultures of organizations. And there we're not looking for good cultures or bad cultures. We're looking for effective cultures. And we're looking for cultures that will be instrumental in driving the performance of businesses. And one of the things that's striking about Anthropic is that they have a very strong culture around AI safety. And over the long run, you do need to make sacrifices to maintain cultures. And so where we see companies, and we're seeing this in the case of Anthropic, making sacrifices and taking difficult decisions to act in ways that are congruent with their cultures, we applaud that because we think it enables companies to survive and thrive in the long term.
Peter Singlehurst, head of private companies at Baillie Gifford. It's been great to have you back on Bloomberg Tech. I really appreciate the depth that we went into across some of the companies in the portfolio. Now, coming up in the show, we're going to speak to Lucid's CFO, Taoufiq Boussaid, after a kind of difficult day for the shares yesterday. Simple story. Investor Day, they told us about the future and more about their plans for robo-taxi. That conversation's next. This is Bloomberg Tech. Lucid is trying to prove it can be more than a luxury EV maker. At its Investor Day, the company laid out a plan to scale into the high-volume mid-size market, partner, more details on the partnership with Uber on robotaxi, and most importantly, shorten the path to positive free cash flow. The big question now is execution and how they pay for growth without burning through too much capital. Joining us now is Lucid's CFO, Taoufiq Boussaid, and welcome to the program, Taoufiq. It's good to see you. I want to start, actually, if I may, with the environment that we're in and just the supply chain impact, but also the financing impact that you're seeing from the war in Iran. Because, of course, Saudi Arabia and different Saudi entities are your biggest backers. What are you seeing on your desk right now?
Well, so for the moment, I mean, the disruption that we have seen have been rather minimal. So we have not noticed major disruption as far as our supply chain and so forth. We did see some tactical adjustment of some of the logistic costs. The shipping companies have indeed increased some of the pricing. But as far as our operation is concerned, we didn't see any disruption for the time being. So we will need to see long term if the events and the tension are extending for too long, how it will impact the business. But for the moment, I have to say that the disruption is rather minimal.
The big headline for you in the finance org was a timeline or a plan to get to positive free cash flow.
Yes.
I'd kindly ask for a little bit more detail. Mm-hmm. What is the timeline on that? And mechanically, like, what is it? What are the levers you can use to achieve positive free cash flow?
Yeah. So we have two important milestones. The first one is the gross margin positive, and this is expected to happen in the midterm, and you should read midterm, basically the next 3 years, and the free cash flow positive is expected by the late decade. So this is the plan that we have. This is the guidance that we have provided yesterday during our investor day. So several levers that we will be activating to get there. First of all, I mean, we are in an industry where scale is important. So scale coming out of mid-size is one of the key catalysts to allow us to go to break-even margin and cash flow positive. So that's the first lever. The second one is the margin improvement and the additional revenue streams that we will be adding to our top line. So the margin is expected to improve on the back, again, of the scale, the various improvements that we're doing, not only in terms of constraining the bill of material or constraining some of the cost lines that we have in the company. It's also about simplifying what we will be bringing to the market going forward. So when you work on a platform with the 95% part commonality over time, this is how you leverage the cost, and this is how you constrain it and you accelerate the journey towards the gross margin positive. Then there's the additional revenue stream, and I guess that we will be talking about that, the fact of adding software revenue, revenue from business partnerships on robotaxis. This is an additional catalyst which will accelerate the journey.
So we are so focused right now on the business model for robotaxi, for all the different conduits of what is a web of partnerships, right? You have announced Project Luna, purpose-built robotaxi, two-seater. But what I want to understand is, at volume, there's a financing risk and an execution risk from taking the vehicles off the production line and then a fleet operator taking them. So who takes on that burden? Whose balance sheet gets that done?
Well, there are different models, and these models are not meant to be static. So, I mean, speaking about what exists and what we already know. So the first deal that we have done with our partners, with Nuro and Uber, was a deal which was based on the assumption that Lucid provides the technology and the platform and the car. Nuro provides the software and the AI autonomous driving capabilities, and Uber takes on the asset. So this is how we have set up the first iteration of the deal, and we have always said that there will be other iterations, and yesterday the first step has been announced. It's not completely finalized. It will be finalized in the coming weeks, but we have announced what the next step would be. And we can perfectly imagine that things will evolve over time. So the whole question is about the value chain in the ecosystem and how it is split between the different components or partners being involved in this business.
Tawfiq, we're having a finance conversation, which is, you know, it's appropriate. You are the CFO. I wonder, like, how interesting the mechanisms can get. Like, you know, Uber has a financial interest in this, but they have a capital-light model. So do you see maybe private equity or the banks coming in with some kind of special purpose vehicle, right? They finance that block of volume production until some time where the fleet operator pays you and says, here's the money for all the cars that we're taking from you. Because you're not going to operate the service, right? You're not going to operate the fleet. And then, you know, to what extent do you need some revenue guarantees from those other partners?
Yeah. So obviously, I mean, the gold standard in this kind of businesses is to secure recurring revenues. So this is how you spread the risk over time, and this is how you give confidence on the validity of the business case. Having said that, I mean, we are also staying away from whatever is associated with the capital-intensive business. So I don't think that we will ever have a model where we own the assets and we generate revenue out of it. There are companies who do this kind of business very well. Companies, institutions, businesses who are experts in managing assets. So I think that over time, with the growing robotaxi market and the expectation in terms of growth, and you saw the various assumptions in terms of market size, it's really ranging from $300 billion to over $1 trillion, depending on the study you look at. I think that this will create new business models and new operators who will start joining the overall value chain over time.
And that's the bit that our audience really wanted to understand. Tawfiq Boussaid, Lucid CFO, it's great to have you on Bloomberg Tech. Thank you. Now, coming up, we're going to talk about the US government's effort to enlist Silicon Valley in its AI warfare ambitions. Stick around. This is Bloomberg Tech. The Trump administration's decision to blacklist Anthropic after its dispute with the Pentagon has sparked debate about how the government does business with the technology sector and buys AI. Here's what the CEO of Dell, whose biggest customer is the US government, told Bloomberg.
We're kind of a foundational provider of the infrastructure. What I can say from our standpoint is obviously we have various controls and systems to make sure we're selling to the right, to the authorized users. But I don't think a company can dictate to a sovereign government what it does with its tools.
It's also cast a spotlight on efforts to enlist Silicon Valley into the government's vision for AI warfare. That's the focus of the forthcoming book from Bloomberg's own Katrina Manson, Project Maven. Katrina joins us now. The timing of this book, the recent reporting that you've been doing, this is the story right now. The use of technology in the government's relationship with the technology sector. I guess take us inside what you've written and the conclusions that you've reached.
Thanks so much. I think the thing that I've discovered is that this effort to bring AI to war that started in 2017 with Project Maven, and then we learned much less about it after Google workers protested, and Google obviously didn't renew its contract, but the effort kept going in two key ways. We already publicly know about one of them, which is Maven's Smart System, the system designed by Palantir, but including lots and lots of different data feeds to help narrow down target selection on a sort of digital, almost a Google Earth platform. That's one thing. But the thing that we really look at in the story that we've published today is the way that the military has tried to put AI onto drones. This is this big effort that, of course, is at the center of Dario Amadei's concern about the development of fully autonomous weapons and the way AI might be used at it. I've looked at one element, which is computer vision. That isn't the thing that he was worried about. He's worried about LLMs. But the effort to get computer vision onto drones is about allowing drones to recognize targets, select them, and then be able to execute fire on them.
Bloomberg's Katrina Manson, author of the new book, Project Maven. Thank you very much, and it's due out very soon, later in this month. That does it for this edition of Bloomberg Tech. Actually, since we've come on air, this is what financial markets look like. Nasdaq 100 is now down 0.5%, a big move higher in the US 10-year yield. And again, Brent crude, the global oil benchmark, we're above $100 a barrel. We focus on the war in Iran and the technology sector. Check out the podcast for the recap. You know where to find it. This is Bloomberg Tech.